really frankly creates barriers because that's what most of when I talk to these companies, that's the biggest issue is they're not looking for help. They're just looking for the government to get out of the way.
We are now joined by recovering investment banker and New York Times bestselling author, Carol Roth. Good morning, Carol. I want to dive into the economy, and I know we always focus on markets, but I think that at this point in the year, where are we in the U.S. economy right now?
I think we're in quite a bit of uncertainty, probably not so much unlike the broader markets. Obviously, everybody's hanging on President Trump's every word to figure out where we're going next. There's obviously a lot of optimism when Trump was elected with the hopes for massive deregulation, for some tax certainty, lowering barriers to growth and the like. And I think that everyone was thrown a little bit for a loop in terms of the order of operations that we got, tariffs and Liberation Day before we got some of the others. I do think that we are, at least, especially with Scott Bessent out being one of the lead communicators, starting to right that ship at least somewhat, starting to seem like we're going to get something out of Congress that maybe gives a little bit more tax certainty. You've got Bessent talking about, maybe as early as this month, seeing deregulation, possibly starting with the banks, and at least on the tariff front for those businesses, particularly who are dealing with China, 145% tariffs. That wasn't a tariff, that was an embargo. That was, we're not going to do business at 30%. While that does have a massive impact, at least you can have a strategy. So I think that, there is some cautious optimism in certain places, certainly in small business. When you look at the small business optimism index, it is down over the last few months, but that's something that I can see moving and shifting, as things progress, hopefully with the trade deals, assuming that they don't move backwards, that we're moving forwards. And then, kind of the other piece of what's going on that we're just starting to see impacts from is AI and, what that may mean for the job market, particularly interestingly, the white collar job market versus, the traditional middle and working class. So I think there are a lot of interesting dynamics at play right now.
And if we look at markets, I mean, obviously, we're still tariff-wise, we're still at a 90-day pause. So we're still nowhere. We have no actual solid deal from any country, just sort of a broad framework with, say, the UK. And yet the markets seem to be completely shrugging this off. Why do you think that we're seeing this? And maybe, we are being led by big tech. Is that all kind of AI optimism that may be leading the markets?
Yeah, I mean, I think that the sentiment, whether it is correct or not, is that the worst is behind us. That Liberation Day was that climax, and whatever comes next couldn't be any worse. That we're moving the car forward, and that we're not going to move it into reverse. I think that again, if we go into probabilities, is the probable outcome, but we do know that we have an administration that likes to throw some curveballs. So there is certainly a possibility that things shift. That being said, obviously the markets have had a vote, maybe not as much the stock market, but certainly the bond market. And given our fiscal foundation and the fact that that is very tenuous and fragile, and kind of without them adding this into the mix, I do think that that's going to be a check for what is able to be done in terms of policy. And I think that when we got, I don't know if you want to call it the Bessent put, when the bond market said, hey, we're about to revolt here, and then we got a shift in strategy, I think that gives enough comfort to say that, yes, there's a boundary here that they're not going to cross.
We do have this big, beautiful bill in the office. How, obviously, we know nobody's going to cut spending. You just can't. No party's going to cut spending. And so, do tariffs actually make up for this excess spending? What is this kind of looking like on the fiscal side? And where does that put the Fed?
These are all excellent questions. My view on tariffs as somebody who works particularly with smaller businesses, some who have part of their supply chains overseas, is that the tariffs aren't being paid. And I know they keep saying that they're being paid by China and maybe some portion is, but mostly it's being paid by businesses and ultimately consumers. So that being the case, even if the US is collecting those dollars at the federal level, it's moving it from one pocket to another. If it's a business that's paying that, that is less money for them to make investments and hire and things like that. If it's the consumers, it's less money for them to spend elsewhere. And so I don't think that that's something that's going to plug a hole in any meaningful way or a long-term sustainable strategy, because one of the things that we know is that the country cannot afford for the GDP to recede. We need for it to grow, and we've seen everybody from Besant to Musk say that. And the reason is because we need to keep those receipts up. And to the extent that we get a contraction or we get money moving from one place to another, that is not helping the growth cause, which is really the driver of receipts. As we know, last fiscal year we took in about $5 trillion, which, by the way, is more than the GDP of every single country on earth except for the US and China. So theoretically should be plenty of money for the US government, but they're still running, a 6 to 7% of GDP deficit, an extra $2 trillion, which is a wartime level deficit that, shouldn't be in existence when you don't have a recession or a war. So in terms of what the Fed does, I'm going to take a little bit of a different slant here and say I don't know that it matters. We had the Fed cut rates last year, and then what happened on the backside of that, we're somewhere 80 to 100 basis points above that on the 10-year yields, kind of depending on the most recent day. And so we are in a period of what is considered to be fiscal dominance, where the fiscal policy is really going to drive what's happening, and the monetary policy, those tools, really don't have a lot of impact. And I think that that's something that's maybe a little bit underappreciated right now. So the Fed can do what it is that it wants to do, but they really have lost control of that long end of the yield curve. And I think that really it is incumbent upon the government to have a strategy. And like you said, it's not happening in the big, beautiful bill, but it would be great in some of these rescission bills, or for them to kind of come out with, a plan for them to reduce spending and create a situation that isn't going to push us into something like a debt spiral or, some similar situation over time. And I think that's, when everybody's focused on the Fed, that they're maybe missing the main part of the main ring of the circus. They're looking at the sideshow.
Carol, I want to end talking about the Russell 2000 because you focus on small business
Yeah.
and in the camp that you're never going to have a really solid bull market from here
Yeah.
unless you have all the indexes working together. I mean, the Nasdaq is always going to kind of do its thing, and it might have a bull market on its own in some ways, right? And the S&P might get dragged up by it, but to have, I think, a real bull market, it's good to see all the indexes working together. The Russell continues to struggle, and that is the market that is reflective of the small business. So talk to us about what you're seeing in the Russell and why you think that it continues to lag the major markets.
Yeah, I think that first of all, it has become very difficult with regulation, with Sarbanes-Oxley, all the different rules that they have for companies to come public. So you have, some of those who might be great investments or leading in the kind of small and medium area, who really don't want to or can't deal with being a public company. And so the choices of who you have, tend to be a little bit more limited. And then, you do have all of these barriers and this tipped playing field that we've seen over the past, 15 plus years, first with ZERP and then with some of the regulation that really has benefited the big players, but the smaller players don't have the same kind of scope and scale to take as much advantage of that. So I think, maybe when you get some of the tax certainty and deregulation, that then you would have a scenario to help unleash a little bit more of the growth from the smaller players. But at the same time, you do have a situation where you have a consumer which is becoming ever more tapped out, and a bifurcation between the haves and have-nots in the consumer. And I think that is weighing heavily on those smaller companies. And to the extent that something isn't done to provide some relief at the consumer level, I do think that that also can have an issue, for some of these smaller companies. So even though I'm a huge small company advocate, I do see a rocky road ahead. And it's one of the things I would really like to see out of this administration, because we've heard from everybody from Trump to Bessa that they are going to be Main Street first, that they're very, focused on the smaller entities. But we don't have a lot of people at the table who have deep knowledge of this segment of the market. You've seen a lot of the technologists hanging around, and you've seen government policy guys, but the people who really understand kind of the inner workings of the smaller business and how this regulation impacts these companies and really frankly creates barriers, because that's what most of when I talk to these companies, that's the biggest issue is they're not looking for help, they're just looking for the government to get out of the way. And I think that if the Trump administration brought more of those voices to the table and could get rid of some of those barriers, that certainly I think would help and would change the fortunes of the Russell. But I do think you're right. There's been, just like in the economy, where there's been a bifurcation and of the haves and have-nots, the same thing with the market. And the Russell, unfortunately, has been the have-nots. And I think that until we see a major sea change, I would imagine that you'll see more of the same.
Yeah, and I just think it creates a bumpy bull market and, with a lot of ebbs and flows within it. And, just tying back to our entire conversation today, what worries me about the small caps and really the consumer is you look at what's happening right now. You've been really in somewhat of a bearish market for commodities. You've been in oil that's been in a holding pattern for a good period of time. And now both of those markets are looking like they could start getting ready to rally. What does that do to inflation? What does that do for confidence? Which we've not seen spending come down that much. We've talked about this a lot, Carol. And I know we're running out of time, but I'll give you the last comment on this. It's like, to me, the inflation story does come back into effect, I think, soon, based upon what I'm seeing in markets. And how does that overall impact, I just think, again, the overall economy?
I think it's almost not a choice that inflation is going to come back, because where we stand with our fiscal foundation, if you look at debt to GDP, deficits to GDP, or interest expense, where the 10-year is now and how much debt needs to be financed and refinanced, there are lots of tricks and creative things that the Trump administration can do to buy us time. But every single one of those is going to be highly inflationary. And if you get, any situation with a move in yields, you get any situation where receipts are down, recession, that's going to just put more pressure there. So unfortunately, the release valve for pretty much everything, unless they're just going to let the markets fall apart, which I don't think that they're going to do, is going to be inflation. And so I think that as we see this trajectory of it moving downward and looking like it's getting back close to the Fed target, I think that's a breathing point. And like you said, we should be prepared for it to kick in probably late this year. And I don't think the consumer's expecting that. And I do think that is going to be a big drag unless, we get, some sort of miracle that happens on the growth side to counterbalance it. So that should be very interesting, because you will probably have a situation where there's more accommodation for the markets, but not necessarily reflective of what's going on with the underlying consumer. So nominally, probably market does well, but on a real basis, that's the question mark.
Carol, this was absolutely fantastic. I can't thank you enough for joining us here on NinjaTrader Live. Carol, you're the best. Thank you so much.
Thank
Nice
you.
to be with you guys. Thanks, guys.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.